Well, good evening. We'll go ahead and get the webinar started. Want to say thank you for everybody taking the time to join us here this evening for the September 20th CattleFax Cow-Calf Trends webinar. First and foremost, we want to thank our sponsor, Elanco. They've been a longtime sponsor of this webinar series and are an integral part in making this series free to all producers. So we want to say thanks to them. Should have a little bit of a discussion there at the end of the presentation from Elanco. But first, just looking at the docket for what we have here for this today's presentation. My name's Terrell Platt. I'll be going through the feed grain and hay situation first. Also tie in a little bit of discussion around the economic factors that we're watching right now, how that ties into beef demand and our expectations for prices there. From that part of the discussion on, Patrick Linnell will take over and discuss where we are in terms of supply and demand on the cattle side, and also finish up with an outlook for the remainder of this year, as well as the spring of 2024. So just starting with a high level on the corn side predominantly, best just to start and take a look at where we are from a balance sheet perspective. And I've outlined here in the red boxes kind of the key factors that gives you the right taste of what's going on with the corn side here as we head into harvest this fall. We got the WASDE for September out there just a couple weeks ago, and no big changes across the balance sheet. The only real things that the USDA adjusted are both planted and harvested acres up around 800,000, and then yield up or yield down, 1.3 bushels per acre. When it comes down to it, though, no big changes in terms of stocks to use. We were at 15.3% estimated with the August WASDE, up that to 15.4 with the additional acres that the USDA reported in the most recent report. All in all, it doesn't look like the corn situation is changing a lot from a fundamental perspective. If there is any risk, there's certainly potential we could maybe lose some acres as we go through the harvest side with some of those drier areas, but yield is likely to be right on target in that low to mid 170s mark. If you lose some acres, that can take your stocks to use a little bit tighter. But the other component that we need to watch on the balance sheet side is definitely on the export end, where we actually have larger exports penciled in for this year. That makes some sense with a larger crop. But what we have to take into consideration is this year Brazil had the largest crop on record down there, their largest crop, and they're likely going to be a pretty big competitor for us on the world market, especially from a price standpoint. They have the competitive advantage there. So if we do lose a little bit of production on the acreage side, likely see that balanced out with a decrease in exports as well that leaves stocks to use relatively similar. We just take a look at planted acres relative to history. One of the largest numbers that we've had, especially here over the last decade or so. In addition with that, harvested acres, they're above 90%, the largest we've had since that 2016 timeframe. So those, especially on the harvested side, that's probably the point where we could see a little bit softer of a number there. Doesn't mean it goes below 90%, but could it be a little bit below that 91.5 or closer to 91%, I think is certainly a possibility that we need to keep an eye out for. Still, yield is right in line with where we've been the last several years. Only been near trend line once here in the last 5. So just that expectation where we were a little bit drier this year, especially in those key corn production regions, seeing the yield a little bit lower, both off trend line and closer to the low to mid 170s is within expectations. If we do look at corn futures and just kind of the dynamic that this market has shifted in over the last several months or into really the summer of last year was when we saw the peak in corn prices. And we've held a pretty consistent downtrend since then as the market has grown more comfortable, especially here this year from that kind of January to March timeframe. Rather large decline in corn futures prices all the way into today, marking a lower end of the range there in that kind of 470, 475 range. And especially if you look at the price action here more recent over the last several weeks, it does appear that futures are fairly comfortable with the supply and demand outlook and continue to trade in a stocks to use level between that 14 and 15%. We're likely near support though. If we just look back at some of the technical indicators, you have long-term support there at 462. Could we go down and touch that level for a little bit? Certainly, but likely not have a bulk of the risk priced in on the low side. At the same time, have some resistance to corn futures going much above probably 5.25 on the high end here over the near term. You can see we've had some volatility through the growing season, especially where it was drier early on in that May and June timeframe. Pretty stout rally off that 480 level up to 6.25, but came right back down when the rains did end up manifesting. Same kind of story there with that rally that occurred in July. But as we've come through the growing season, the market does appear very comfortable. And if we look just from a stocks to use standpoint and where futures are today, what we're pricing in, at that kind of 470 level, we're actually pricing in a little bit bigger stocks to use than what we'd be calling for today. With the WASD, we're closer to 15.1, and see there's certainly potential to be maybe closer to that 14 and a half level. And you can see where the risk is still pretty limited to the upside, even if we do end up a little bit tighter on the production side. We're looking at a cheaper corn environment here this year. We're also seeing that reflected in terms of basis trends across regions. And ultimately, what that comes back to in terms of the cattle industry is substantially cheaper cost of gains than we've been facing through the bulk of last year and the year prior. Certainly advantageous and supportive to feeder and calf prices as well. Having those cheaper cost of gains allows for a better break even on those feeders as they're placed into the feed yard. We just kind of look at corn, spot corn futures from a range for this year, likely to average pretty close to 5.25 when it's all said and done. Definitely seen that big decline reflected where we started up there closer to $7 there on the year. 680 was really the high, and back down here actually exceeded the low that we have on the chart here, just a tick probably. And then next year though, on 2024, not much changing. Still looking pretty comfortable from a production standpoint when we look at the weather factors that we'll talk about a little later. Shifting towards that strong El Nino weather pattern into the spring of next year should lend towards a favorable growing season and keep stocks to use at fairly comfortable levels. If we look at the hay side, not quite as friendly of a picture here just yet. We only have the stocks data through May. They release this report twice a year. We'll get another look at it here in December. But for now, you can see we're near some of the lowest levels there in the last 30 years from a stock standpoint. Down 14% from a year ago at 14.5 million tons. But one thing that we can look at is acres harvested, a projection there for 2023, as well as our yield and production indicators, where we come through the summer growing season, and all a lot more friendly type of supply dynamic than we faced, especially last year, where we were looking at some of the tightest hay stocks in the last several years. So certainly positive from a hay perspective. If we just look at things from a price side here near term, we only have prices going back through July. Not seeing a ton of shift outside of prices out west, where they have come down quite a bit, but are still the highest cost on average relative to the 4 key cattle producing regions, at least through the month of July. But if we look here, a nice indicator we can use is the correlation between hay prices and corn futures. And you can see over time that those do tend to move directionally together. So with this cheaper corn environment that we're looking at here as we head into the harvest season, would be supportive that hay prices will continue to be cheaper than what we have here today for that July timeframe. I mentioned El Nino. Matt Makins puts together our weather forecasts and continues to point towards a strengthening El Nino pattern here into the fall and into the spring of next year. And if we look at what that kind of would indicate from a weather perspective across a regional basis from November and into April, first looks like we should have a little bit warmer of a temperature, warmer winter we should face here up there in the north, a little bit cooler in the south, and then a better moisture pattern across the south and into the central plains. The timing of this moisture is going to be key, and whether it comes in the form of snow across these key cattle feeding regions and key cattle production regions, or if it'll be later in the springtime and be more on the rain side. But either way, having more precipitation is certainly friendly. What we do need to keep an eye out, though, is some of these drier regions that we see across the Rocky Mountains and up north, and keeping an eye on snowpack there for indicators of if we're a little drier in some spots when we head into the summer of next year. No, I think the economy is certainly something that's been on everybody's mind this year. And if there's anything that maybe comes as a little bit of a surprise as we've come through 2023, is things have actually fared a lot better than I think a lot of folks expected, ourselves included, where we've made it through almost the first 3 quarters of the year. We just take a look at where we are from an inflationary standpoint, it is a lot better of a situation than we had a year ago. We've seen inflation moderate back towards that 3 to 3.5, 4% level in the most recent data there in August. But at the same time, we're facing a lot higher interest rate structure than we have in the last several years. They did keep the prime rate steady in their most recent meeting, as the Fed met today and released or made that decision today, but are still pretty hawkish when it comes down to it. I'm not sure they're convinced that inflation is to their target yet and is going to reach it here in the near term. They'd like to see inflation down to 2%, and it might be at this more moderate type of 3 to 4% level for the time being, especially when we consider the action that's going on in the oil market and energy prices. Keeping those pretty firmly supported can leave inflation a little bit higher. In addition, on the food side as well, with heading into tight supplies and some of the key commodities can leave inflation a little stronger than maybe they'd like to see. If we think inflation is going to be a little bit more on the moderate side and certainly above their 2% target, we should still expect to face a higher interest rate environment for the next 12 to 18 months. I think they're going to be on the cautious end of the spectrum. And really, if we draw from lessons back here throughout history, in particular in the 80s, they raised interest rates up to that record 20% level and then aggressively lowered them. But I think the argument could be made that at the time that was too quick of a softening in terms of interest rates, and you had inflation stay high, and they had to take them right back up. I think they're trying to avoid that type of situation and are going to be more leaning towards keeping interest rates a little bit higher, a little bit longer. That's something to take into consideration, both from a consumer demand standpoint, especially as student loans start to come due. Could put a little bit of a squeeze on consumers, but also as we look towards expansion, which Patrick will talk a little bit more about, the cost of the investment in rebuilding a cow herd or other assets on the ranch is going to be a little more expensive, especially relative to the last cattle cycle where we had interest rates closer to zero for all intents and purposes, where that fueled a lot faster rate of expansion because money was much more readily available from a loan standpoint. On the positive side of the economy, though, we can look right to the job market that continues to remain historically tight, where you have 1.4 jobs per person that are open for everybody that's out of work. Now, that number has started to tick up a little bit in terms of jobless and wanting a job now here recently, but looking here over the last several years and through into the last 5 years or so, still near the lower end of the range. We view this as really positive. As long as folks are employed and getting paid, that's positive from a demand perspective. It's cooling, but still remains historically tight. On the income side as well, we see some positive action there. We certainly don't have the same kind of stimulus money that we saw through the COVID period that fueled some exorbitant prices on the beef side. But if we look relative to history, consumers are still fairly well off in terms of the balance sheet on paper. Now, they may not feel like everything's great, especially with inflation staying as high as it is, or still staying somewhat high, and interest rates as high as they are. Doesn't feel like the economy is just whipping right along. But from an income standpoint, if we compare back to the last time we were at this kind of stage in the cattle cycle and this kind of price level in the cattle cycle, they actually have added about $8,000 in real dollars to their income over the last 10 years or so. Certainly not going to feel like that, but something that we'll need to keep an eye on to make sure people stay employed and continue to hopefully see these incomes continue to rise again as some positive factors on the demand end. If we look at retail beef prices, we really noticed a shift kind of there in the first quarter of this year, where retailers kind of started to get squeezed from the wholesale market as wholesale beef prices have trended higher really through the first 6 months of the year, and then been elevated, more range bound here since then. And as we squeeze those retail margins, they've elected to start to raise these retail prices in order to preserve that margin and in an effort to ration tighter supplies that we have on the cattle and beef side. We reached record prices for the last 3 consecutive months. They're in June, July, and August. Although August was a little bit more moderate of an increase, you had a massive increase in this retail price in July. In terms of what we expect retailers to continue to do over the next 6 months and into next year, they're going to continue to be aggressive in raising this beef price. And really, it's going to find out, unfortunately, it'll price out some consumers in terms of buying beef, but it'll find out which consumers and what consumers are willing to pay for beef at the grocery store. We think we'll reach about $8 here by the end of the year and start to flatten out a little bit. And then as we go through another big drop in supplies into 2024, we'll likely stay supported above that $8 level in terms of this all fresh price, with the potential to push up towards $8.50, maybe even higher, depending on how well demand holds together. Now, one thing we have noticed as well on the demand side, when we kind of compare back to beef prices relative to our competing proteins, we've noticed a shift in the price change dynamics that have started to occur here in the late summer relative to what we had in the beginning of the year. In the beginning of the year, you can see beef had this kind of flatter price trend and wasn't going up very much. And we did see higher prices on the pork end and on the broiler side. Now, if we look today, that dynamic has switched, where now there's higher prices for beef. And we're actually seeing competing protein prices move lower. So maybe not as much trade down as you'd think, even though we're at record beef prices, not necessarily indicating that consumers are increasing their demand on the pork and chicken side. The other thing that we can look at as well is earlier in the year, we had ground beef prices going up a lot more than either all fresh or choice on a percentage basis, which would indicate trade down as well, right? More consumers going to the cheaper product on a dollars basis. But now we're still seeing those prices move higher for all fresh and choice in particular at the retail counter. That's really important as we come through this part of the cycle as well. We think about just the growth in the dollars in the system. Certainly starts, one of the areas we can grow those dollars is at retail. So as these retail prices go higher, that funnels more money into the system. And when we get to this kind of stage of the cattle cycle in terms of tight supplies and having fewer cattle than we do plant capacity, that favors leverage on the production side of the chain. So back to the cattle feeder, stocker operators, and cow-calf producers as well. So not only are retail prices going higher, but cattle producers will get a higher share of those dollars as we go through the next couple years as well. I think the other thing to talk about as well on the demand side is just what does it look like when we're at record prices from these kind of demand levels. And it doesn't compare yet to 2021, but we're about even with 2022. But keep in mind those incomes that we had in 20 and 2021 as well. That this beef demand number was likely a lot stronger because consumers had so much more income around them. We've seen that moderate, but we're still near the upper end of the range and well above the 20-year average in terms of retail beef demand. So even though we're at these high prices and need to be watchful of consumer pushback, we're continuing to see this demand stay at historically strong levels, and based off our forecast through the end of the year, looks like it'll continue to be that way. And that'd be similar to what happened when we came through that 2013, 2014, 2015 type of price cycle as well, where retail had to move higher. And maybe it's not true genuine demand growth, but it is demand rationing, and that concept of figuring out and determining which consumers have the highest willingness to pay for beef. We take a little bit broader perspective and a step back. This would be the same kind of metric on the retail demand side as well as retail prices. And you can just see the demand growth that we've gone through not just the last 2 decades, but the last decade as well. Since we had the last cycle highs there in 14, we still are seeing stronger demand yet today, even though it's a tick softer off that 20 and 21 and 22 level. And that's a very normal thing to see, where prices still go higher, but demand softens a little bit. Here you have demand a little bit softer as well, a little bit moderate. That was when prices did have to come back a little bit, but we're still expecting more of a dynamic where prices at the retail side still have plenty of room to go. We think really one of the key things that has occurred for the industry or occurred throughout the industry that's really driven this demand growth that we've talked about since 1998 is the improvement in the quality of the product that we're producing. If you look at these percentages here, all through COVID and even into 2023. This is the best product we've ever put in front of the consumer from a quality grade standpoint. And we think that, one, from an enhancement in genetics in terms of feeding cattle as well, has continued to make those increases. We may flatten out here near term, but we think about as well the genetic turnover that we'll see as we move towards expansion. You can see kind of similar to the last cycle where we rebuilt the herd with better genetics. We got another lift in this quality grade as well. So as the industry continues to invest in those kind of genetics with high quality grading cattle, that's very supportive to demand as well. So even though we're facing some headwinds on the economy side, I think it's worth giving credit here that the product is better than it's ever been before. That's what I have for you guys. As far as the grains and economy and demand side go, I'll pass it over to Patrick Linnell, and he'll go through a little bit more of an outlook and with how that relates back to the cattle markets.
Sure, thanks, Terrell. As we do, before we dive on into the second portion of this discussion and really dive into where we do interpret things being in terms of the cattle cycle, and then given a more short-term outlook here, do want to encourage everyone. We do have a couple questions that have come in, but we will save a few minutes at the end after we hear from Dr. Faulkner with the Landco. We will save a few minutes for questions, so please add any questions that you do have into the question box, and we'll save a few minutes to go over those. So as we do start thinking about the cattle cycle, again, the two major factors that come into play in driving the expansion and liquidation pattern that tends to follow a 10-year pattern really comes down to two things: drought and forage availability, and then profitability and cash flow. And so as we do think about the profitability scenario, we'll talk about that here in a minute. Obviously substantially improved, and especially will be as cow-calf producers start cashing checks from this year's calf crop. But as we do think about the other major factor there, as we think about drought and feed and forage availability, much improved for many parts of the country. But as you look at the most recent drought monitor map here in front of you, still plenty of challenges out there as well. Especially as you think about parts of Texas, but then you look at the areas in the drought map up there into Nebraska, Kansas, has been certainly some big challenges in Missouri, another major beef cow state, as well as stretching on up into the Corn Belt. So main message is that conditions by and large are improving to some degree, but still some pretty major challenges in some areas. Again, the forecast that Terrell walked through does suggest that that's improving, but this is important as we think about the timing of this cow herd expansion, and thinking about producers in some of these areas still impacted or maybe pretty limited in their ability to retain heifer calves this fall. While we do believe that those areas that are in better shape will see more heifer retention. So just for perspective again about where we're at in terms of drought, as of the latest full months of data, they're in August. Around 35% of the nation's beef cow herd lived in a state designated as under drought conditions. A big improvement on a percentage basis from where it was in July, but obviously still a pretty substantial portion of the nation's beef cows living in drought. So as we do think about the price picture, and there is plenty of comparisons comparing this year's price action to 2014. And as we think about how impulsive the market was during 2014, you can understand why as we think about this massive jump that we've had in prices this year. And this would just be looking at fed cattle. But it is important context as we think about how these cycles tend to play out over time, that We don't believe from here going forward that this year really does match up with 2014 as you think about some of these cyclical dynamics, as we'll continue to talk about. But the important thing to think about here is as you look at over the next couple of years, if prices were to top out in 2013, or excuse me, in 2023, that would be the shortest cattle cycle for those that we have mapped out here, going clear back to the 70s. And even if it topped out in 2024 next year, that would be the shortest going back. So as we do look going forward, we still anticipate that this cycle does have room to run. Now, it is interesting as you look about the extent of this price rally that we have forecast here, but it is important to recognize that that is relative to the low, which was the COVID low, and obviously pushed the market lower than what normal fundamentals would have pushed it. Now, as we do look at the beef cow side of the equation, again, two ways that you can really influence expansion and contraction, heifers on one end and beef cows on the other. So as we do look at the beef cow slaughter pace, again, substantially lower than a year ago, down nearly 14% through the last few weeks here, compared to where it was at this time last year. However, it's important to recognize that that's slaughtering nearly 400,000 less beef cows, but that's on a beef cow herd that came into the year with 1 million less to begin with. So as we look at this year on a culling rate basis and take beef cow slaughter and divide it by how many beef cows you started the year with, this will still be what we would term a net culling year. Still a year where chances are the beef cow herd will be smaller into January 1 of 2024. And that's on the back of the most rapid culling rate that we've seen in history that we did last year. And again, as we do think about a cow-calf producer that had yet to see any real benefits in terms of prices, as the higher prices they were receiving for calves were offset by surging costs and obviously drought impacting many producers as well. As we do look going forward, anticipate this improving and dropping down as we look towards next year, but still recognizing that that's a slow ship to turn in many parts of the country. Environments, pasture condition, it does take some time to improve. So as we do look at the heifer side of the equation, this looks at the number of beef replacement heifers from the USDA survey as a percentage of total heifers. And so you can see the number of heifers that we had coming into this year on a retention basis, or as a percentage of those total heifers out there, was the second lowest, going clear back to the 1990s, as shown on this chart. And this is important, again, as we think about the timing of this cycle. It suggests to us that heifers can always move around. There is some leeway where heifers sent towards a terminal route can still be diverted back to the breeding herd. But no data that we see today suggests that that was done in a massive way, and doesn't suggest to us that, while we know that there was some increased breeding of heifers here this year, by and large, as a nation, that didn't happen this year, which means that you didn't have more heifers bred this year that would be dropping a calf in 2024. But as we do look going forward, do you anticipate that this fall, again, producers in many areas where Mother Nature allows will be retaining a few more heifers and increasing that percentage? And we still do anticipate that that trend will continue for a couple more years. But again, as we do think back in comparison to the last cycle, we don't anticipate these massive levels of retention taking place, just thinking about the headwinds that are out there. Again, Terrell talked about one being interest rates, certainly one issue, as we do think about financing and expansion. But then also those other structural issues, talk about an aging producer demographic, urban sprawl and the number of acres that have been taken out of production over the course of the last 10 years. And other issues as well, and likely favoring just a slower rate of expansion. An expansion, but a slower one. So as we think about charting the course for the beef cow herd, as I mentioned, we do anticipate that we will see another decline in the beef cow herd as we roll on into January 1 of 2024. 2 May beef cows have made their way to town year to date, and on top of that, again, too few bred heifers as of January 1 of 23 that would have dropped a calf in here throughout the course of 23 and be counted as a beef cow in 2024. We do anticipate, again, that drop in the culling rate next year does add a few beef cows into 2025. And again, the result of heifer retention this fall, in heifers retained this year, bred next spring in 24, drop a calf in 25, counted as a beef cow January 1 of 2026, where you start really seeing that take place with the increase in the beef cow herd. Now, how does this play out in terms of fed slaughter and tying it more back to some of these other market dynamics? And a really important thing that we believe that folks need to keep in mind is as we do head into this next expansion cycle into the latter half of this decade, and we'll be in a pretty different environment in terms of packing capacity than where we were headed into the last expansion cycle. As we recall, again, for decades, and especially from the 2000s into the first half of the last decade, as an industry, we were shutting down packing plants. And with the projects underway to increase packing capacity, does suggest that, again, how much of that comes to fruition, just remains to be seen. But nonetheless, the trend is pretty opposite of that, is that we will be adding packing capacity, and much of it scheduled to come online as fed slaughter does start to turn, and especially considering the ramp up that takes place in those facilities. Again, it does pose the question, do we see a major plant shut down and during this time frame in this cyclical contraction of fed cattle supplies? Very well could. But ultimately only time will tell. But again, important to recognize that unlike during the prior cattle cycle, there are projects to increase packing capacity. And so as we do think about the turn in the cattle cycle, as supplies do come back, what could that look like in terms of leverage dynamics? As we do think about, again, a slower expansion coupled with this trend of increasing packing capacity, to at least some degree, does suggest that it will favor not seeing such an abrupt collapse in the marketplace as the rapid drop that we saw in the last cycle. Again, a tremendous amount of moving parts here, especially as we think about forecasting as many as 5 years out, but some important things to keep in mind. So as we do think about fed slaughter and thinking about beef production, we're on pace to see around a 3 million head drop in fed slaughter from the peak in 2022 down there to the lows in 2025 or 2026. And again, as we do likely think about the balance of trade, we'll likely see that offsetting to some degree as we do see our higher domestic market likely attracting some more imports. And then on the other side of it, higher prices and just less production does favor that we'll see some headwinds in terms of exports. And that's kind of setting aside any potential questions around how well will the global economy hold up, again, during an inflationary period, not just here, but abroad as well. So as we do think about that trend, at the end of the day, we will be dropping per capita net beef supplies or consumption. Again, what's production net of trade divided by population? We'll see it dropping from around 59 pounds per capita down there closer to 53 pounds per capita. A 6-pound drop in supplies is a pretty substantial tightening, and will certainly be a major factor in pushing prices higher at the wholesale and retail level. So as we do continue to look going forward, in rough roadmap, as we do think about price levels going forward, and still believe that there is more upside here. And in particular, as you think about feeder cattle and calves, have certainly been hammered by some issues with rising costs of gain, higher feed grain prices, especially through the first half of this year. Now, obviously, corn, as Terrell talked about, has softened in more recent months and provided some upside here. But again, as we do look going forward, still believe that there is some room to run there. And as we do think about just fed cattle prices in general, one important thing to keep in mind is that the industry has yet to retain heifers yet in a big way. And we'll talk about that a little bit more in a minute. So as we do turn the page a little bit here and look more near term, as we look at the on-feed situation, here our estimate for the month of September remains with feed yard inventories near their seasonal low, as is typical during August and September. As we compare back to the last few years in an on-feed supply that's down around 2.4% from a year ago, and also down around 1% or 150,000 head from its 5-year average. Do expect that in on-feed numbers will climb, is pretty seasonally typical here through the end of the year, but remaining around that bottom end of the 5-year range. Again, as we just have smaller calf crops, let alone seeing if we do end up retaining more heifers, or these improved drought conditions in many areas, in particular the rains that have come through some of the winter wheat grazing areas, if that does keep some more calves out on winter grazing operations. So as we do think about that on-feed supply that's below year ago, as we think about the pattern for fed slaughter, I continue to expect that we will see declines in the fed slaughter supply here in the months ahead. And as we do look back over our shoulder here, and think about how well supported this whole market has been throughout what's typically the summer soft spot for fed cattle prices, you can sure understand as you look at the massive drop that we've seen in the slaughter rate on a year-over-year basis, just simply tighter fed cattle supplies in driving these high price levels. And again, that drop compared to either a year ago or the 5-year average going forward, it will continue to support the fed cattle market from here forward, and still anticipate seeing those large reductions as we roll on in towards next year. And keep in mind, as you do think going forward, if we are still anticipating another 1 million head drop in fed cattle slaughter next year, and that does set the stage for seeing pretty significant and pretty consistent declines in the fed cattle supply throughout the course of next year. So in terms of the price patterns here going forward, we have started to see in last week, fed cattle prices in the southern plains did start to move higher, and expect that we will continue to see this higher trend unfold as we work on in towards the holiday season. In particular, again, driven by both a firming beef complex as we do work deeper into the fourth quarter, but then also again that seasonal drive for the holiday rib and these tightening fed cattle supplies in taking a market likely up above 190 before the year is up. And as we do look to our forecast for next year, and anticipating an annual average currently of around a 194, and leaving upside up to that 205 to 210 area, and potentially getting there to a spring high, seeing some kind of a pullback throughout the summer, and then rallying again into the fourth quarter of next year. Again, plus or minus targeting that same area as we get to in the spring high. So as I mentioned, as an industry, we still haven't started to maintain or retain heifers in a large way. As you look at the July 1 estimate of heifers as a percentage of the on-feed inventory, you still see that trending at the upper end of the historical range and matching some of the highest levels that we've seen clear since that 2000 to 2001 period. And the number of feeder cattle and calves remaining outside of feed yards, it does remain tight. As you look at a supply that's down 1.3 million head compared to a year ago, and as of the latest data point that we have from the USDA as of July 1, and just fractionally above, only 100,000 head above that supply as you look back towards 2014. And important to keep in mind that again, this is including feeder heifers, and so again, as we do start to retain more heifers, it does introduce another leg to the tightening of the feeder cattle supplies here going forward. As we do look back over our shoulder at these video auctions throughout the summer, and this would combine those major video sales, Superior, Northern, Western, an insanely high increase compared to last year. On average, most video sales up $80 to $100 per hundredweight, not per head, but per hundredweight compared to a year ago. And again, with those smaller increases tending to come earlier this summer, and generally speaking, those larger increases on a year-over-year basis during these later sales here. So again, certainly a positive trend to see here for the cow-calf segment, and again, expect that this firm market will continue. So as we do look at the spot market here, again, tracing cash prices for 550-pound steers, again, looking at our U.S. average benchmark, you can see continues to trend here in the 280 range. And with the rains that have come, improving prospects for winter wheat grazing, on top of this higher leg recently in the last week or 10 days to the futures complex, does support, certainly will support the calf market. As you look at a 20-year average pattern, 20-year index, does suggest that we are coming into a weakening spot as you just think about that traditional pressure during the fall run. We still certainly could see some pressure as the box outlines here, but again, could also make the case where even if there is some pressure, it'll likely be pretty limited through here. With this benchmark, you'll likely pressing up above $3 before we close out the year. And as we do think, on out towards next spring, again, it really depends on the extent of spring and summer grazing prospects, but expect the calf market to continue to trend higher into that time period. Forecast somewhere up around that 350 mark, and just the extent of the rally will certainly depend on the drought situation and moisture. So some things to think about here going forward. Just looking at some options out there as we think about ways to take advantage of this market and the price trends that are out there. This illustration here in front of you would just be a hypothetical scenario of taking a weaned 550-pound calf in October, a steer calf, and backgrounding him, making him weigh 850 pounds in February. And so you can see that on average, over the last 10 years, the market has paid you around $285 per head to do that. And that would just be suggesting that as long as your cost is below that, coming out dollars a head at the end of the day. As we do look at the futures, basically pricing in that current calf today against futures, implying what that calf would be worth as an 850-pound animal in February. You can see today the market is implying it would pay over $600 per head to do that. So again, as long as cost is below $600, that does imply a profitable move. And similar scenario as you look towards potential opportunities, programs for stocker grazing, a winter grazing operation on the top or summer grazing on the bottom. As you look towards our projections for next year, again, using the futures today and what basis is implying, and again, recognizing that every scenario is a little bit different, but by and large, still just a metric to go by. Certainly implying some pretty stout margins for both operations, both of those grazing programs here going forward. And as we do think about opportunities going forward with retained ownership, certainly could be an opportunity for those who were forced to destock some cows due to the drought and haven't had an opportunity yet to rebuild that cow base. So in particular, could something like this be done with heifers, again, and have the opportunity down the road, and do you sell them as feeders or you put a bull on them, AI them, and sell those as replacement females? Just some considerations out there. As you do look at the feeder market, it continues to perform following a pretty seasonal pattern, again pushing up towards this 250 level, and anticipate that likely hold together here through the end of the year, with potentially a firmer bias as we work here going forward. And as we do roll forward and look into next year, I believe these levels where we're at in that low 250s to 260 area should be support here on into the first quarter, and continue to move higher through the course of the year, especially as we work into the second half of the summer. Now, as we do look at risk management, again, as the market has rallied to such stout levels, we would encourage taking some look at potentially managing risk on those feeder cattle and calves during the first half of the year. Now, I want to emphasize that, again, the fundamentals do remain positive, and our outlook is obviously positive headed in towards next year. But certainly thinking about both the equity that's at stake here with these high levels, and the fact that there's some margin opportunities out there, may be prudent to look at managing some degree of risk, and certainly not looking at risk management as an all or nothing ordeal, and certainly preferring options or LRP insurance relative to futures, as we do think about protecting equity, locking in price, but still leaving some potential upside. And another important factor to think about in looking at cold cow prices, still anticipating some seasonal softness as we work through the fall run and hit the heavy culling season. But as the box here would suggest, plus or minus $1 on a U.S. average price for a utility cow should likely be pretty strong support. Again, still seasonally pressured here, but a smaller than average seasonal break and substantially firmer than the last few years. And anticipating that, again, as we do work in towards the new year, start to see cull cows move higher. And still believe that typical pattern where, if there is an opportunity to take some thinly fleshed, maybe young cows, add some flesh to them, and sell them into that February time period, it typically, 8 years out of 10, tends to be a profitable move, and would be believing that this would likely occur again this year as well. And as we do think about these cull cow prices, again, major factors supporting them as we work towards next year in the next few years is that we will be tightening up that cow market as well, and already seeing those big year-over-year drops as we looked at the cull cow or the slaughter cow chart there earlier. And again, we'll certainly be supportive to the 90s lean market. Again, pretty closely tied to cow prices and where cows are driving their value. Remain stout, blended to these stout cull cow prices, and anticipate, again, that firmer trend will continue next year, in particular as you start approaching that spring grilling demand. And from a leverage standpoint, looking at utility cow price as a percentage of 90s, in black line outlines where we're at today, And these two top lines, again with the markers, outline 2013 and 14, again from a leverage standpoint, still suggest that there is upside here, again, where cows can gain a higher percentage of that 90s lean value. And then a couple other considerations and things to keep in mind as we go forward. As we look at the female market, the replacement female market, and tightly correlated over time to steer calf values. And as we do look going forward, as we do anticipate calf prices to continue to have upside as we work towards next year, it does suggest that females will likely continue to get more expensive as well. Now, obviously, an important consideration, and for those considering expansion, is how long will calf prices maintain at these levels, and then also what's it cost us to develop that female? And just a simple benchmark here, again, far from a full budget, but thinking about how many steer calves it tends to take on an annual basis to pay for a bred cow. Now, again, the important thing is thinking about a bred cow again today. It will be the calves selling over her lifetime, not what they're worth today, but still does provide a pretty good benchmark here as a simple rule of thumb. And as we do look going forward, again, do anticipate that with where this ratio is at today, still does suggest that females can continue to get more expensive. Now, how expensive is obviously the big question. As we look back over our shoulder, again, we know that some of those females purchased at the top during the last cattle cycle and never paid for themselves during their lifetime, as they were purchased up here and they sold calves down here. Now, again, going forward, still do believe that, again, if we do have that slower expansion pattern, can support this market playing out for a few more years. But also thinking about, again, how expensive females can get. Obviously, interest has changed that math, especially for those taking out financing to do that. But even so, even for those self-financed, from an opportunity cost standpoint, again, with 10-year treasuries or those high-yield savings accounts returning on top of 4%, it's important to think about the opportunity cost that's out there. And again, if the function of the market is to price in those kind of things, does it suggest that bred cows never get to these extreme ratios that they were at during the last cattle cycle? And bottom line, again, still believe that there is some opportunity there in whether you're looking at bred cows or retaining heifers, or looking for some bred heifers out there. I do believe that there's some opportunities, but we do need to keep in mind the cost of money and the interest costs, because as Terrell mentioned, clearly a much bigger dynamic, a much bigger factor than it was during the last expansion cycle. And with that, I'd like to pass it over to Dr. Faulkner with Elanco to talk for a few minutes here. And then at the end, we'll entertain any questions. Dr. Faulkner? It looks like we may be having a few technical issues with his audio here, but we do want to certainly thank Elanco Animal Health. As Terrell mentioned at the beginning, they've been a longtime sponsor of this program and allowing this webinar series to be free to all producers. So we certainly appreciate their efforts in that and all that they do for the industry out there. Encourage you all to take a look at their website and think about the solutions that they may have to help you with your operations. So with that, if anybody does have any other questions, we do have one here. Oh yeah, we have you.
All right, I called in on the phone. Conquered technology here. But thank you, Patrick. It's Robin Faulkner with Landco, and it's always tough to follow you and Terrell or anyone else at CattleFax. But I just really appreciate what you guys do, and I can't express how much I've learned over the last 20 years from you about our industry and how we interact with other industries and all the parts and how they fit together, and then they're taking your approach into other areas like animal health and how to be a data and science driven person and how to present that graphically where simple-minded people like me can understand it. And in particular, a Landco and our partnership with CattleFax as companies have a shared vision on helping our customers make data-driven decisions that help them be more successful. But I did want to just say a few words about animal health because we are in a new world, and with these cattle prices and things that are going on, and took a little time to write down what I thought were the three things that we needed to think about in our animal health programs this year and going into fall and next year, and then I actually added a fourth year in the call that I thought was equally important. Because of the economics we're facing, everyone, if they've got forage, looks like a genius right now, and is probably making money if they've got a cow and a calf to sell from her. But just remember that the animal health products, the first reason we use them a lot of times is to protect our risk from losing an animal or a fetus or a calf. And all of those return on investments are worth a whole lot more now than they have been historically. And so something that you used to think, well, maybe that's a break even or it might make me a little money, but it's some trouble. The math is different. So reconsider those and reconsider the risks that you can mitigate. The second reason that we dip into our animal health products is for additional performance and efficiency. Those products have always given great return on investment, whether it's an implant or whether it's an onivore like Rumensin in a ration or a supplement. And again, those products haven't gotten more expensive. Feed has gotten more expensive, and then the value again has gotten considerably more expensive. I was looking at your 550 pounders carried over to next spring being worth $600 instead of $300. So those products definitely pencil in. They don't just pencil in, they're slam dunks. And so make sure that you're taking advantage of those, even if you're profitable, to add some profitability. And then lastly, and this is what I think is the most important thing we can do with animal health programs in a cow-calf operation, is that we can improve the marketability of our animals or access new markets. And I'm going to tell a little story to go along with that. 15 years ago, I was in Wyoming to do some meetings on feeder calf health, and it was 2 or 3 nights in a row. And I remember after the first night, I knew that I had failed, because most of the ladies and gentlemen in the audience sat there with their arms crossed and didn't seem to receive my message very well. And that bothered me, and I thought about it a good bit. But I'm like, well, Robin, that's your fault. You had good information, but you didn't have the right questions, and you didn't approach them right. But in the second night, in the middle of my presentation, the right question hit me. And I asked the audience, I'm like, was there anybody in this room that sold their heifers for more than their steers last year? Probably 150 people in the room, and no hands went up. I said, surely someone did. And actually, a couple of gentlemen did raise their hands, and I asked them to stand up and tell me what they did. And they both had sold their heifers as replacement heifers on a video sale, on the same type video sale that most everyone in that room was marketing their cattle through. So what had happened that first night is me having the accent that being born and raised in North Mississippi brings, and speaking to Wyoming cattlemen who were topping the video sales compared to my part of the world. I didn't have any credibility. But in actuality, those gentlemen were very proud of selling replacement quality females for feeder calf prices. And the ones in that room that had received those replacement heifer prices, it wasn't because they had better bulls. It's because they made a few tweaks in their health program, the way they prepared their calves and marketed them. So everyone on this call needs to talk to your veterinarian, more importantly, to where you market your cattle, maybe some neighbors, and see if there's opportunities for you to increase access to markets or to new markets with your animal health program. And then the last one that I added, and I think this is really important, this one kind of touches my heart on the call. You know, it's real easy right now with these high prices for a lot of us to think about how these are good times and everyone looks like a genius and how much money everyone's going to make. But I know there are people on this call that are struggling. They've got drought or other challenges particular to their herd, and this is not necessarily looking like good times for you, and you're going to have to make some changes and some adjustments. When you do those, make sure that you address your animal health program. If you have to put your cows in a dry lot somewhere or feed them differently, that could introduce new risks to your herd, both from diseases that your old program didn't have to cover the challenges you might have, but also maybe new opportunities to use animal health with something like an ionophore in the supplements or rations you need to feed to make that a little more tolerable and to get you more performance per dollar invested in whatever feed you're feeding. So I'm going to end with that. Again, thank you guys for the information. Thank you to our customers and CattleFax customers that made the call. And if we got any questions, I'll be glad to try to answer them.
Yeah, thank you, Dr. Faulkner, and I really appreciate your points relative to just the value of health and performance. When we do think about the value of gain and the value of a pound being so much, again, let alone just the value per head. Again, with the calf price, at $1,500 per head or more, and the importance of health and performance can't be understated.
And I actually don't think our premiums for cattle that are a little better prepared for all of the evolving niches that we have. And some of those niches are just having a relationship with someone that respects what you do with your cattle. They're not getting smaller as cattle get higher. They're bigger. And, we can talk about the $3 a pound calves, but what about the $5 a pound calves or, some that go other directions. So, all of us need to examine whether we're selling our cattle that are premium cattle with just a little bit of extra work and effort for commodity cattle.
Yeah, very good points. There is one question, a couple of questions that came in here relative to the bred female market, and both talking about bred heifers and bred cows in the price trajectory going forward here. We do continue to believe that those prices will increase. Pretty strong seasonal pattern, where from here through next spring, they do tend to get more expensive. Again, as in particular, as a bred female becomes closer to calf, but then as she has a calf at side, and on top of that, just the seasonality of grass greening up in the spring again lifts up the whole female market as well. So we do believe that will be the case, in particular if grazing conditions can improve in some of those areas that are most under pressure today. Does leave even more upside as we work towards spring. And again, as the industry does flip into expansion pattern, and the cow-calf producer again, is able to capitalize on the revenue from this year's calf crop and increases their buying power. But you do believe going forward here that some of these other headwinds, that the interest in particular, maybe some kind of a headwind can help keep those bred female prices from getting too outrageously expensive. But again, only time will tell. Terrell, would you have anything to add there relative to the female market?
No, Patrick, I think you pretty well covered the discussion and what the key factors are to keep an eye on. But at least as far as the near term goes, it does point towards higher values, but interest definitely being the headwind there and something to take into consideration as we make those investments towards expansion.
Well, with that, we do appreciate everyone's time, taking time out of their evening to be with us here. We will be posting a recording and sending that out to all attendees here in the next couple days. So keep posted for that. Otherwise, again, we want to thank you for your time, and again, thank you to Elanco as well for their continued sponsorship of this program. And hope you all have a good rest of your evening.